All right, so let's get started. So, hello everyone, and welcome to today's Cerini Connection. I'm Ken Cerini. I'm managing partner at Cerini Associates, and I'm excited to have you join us for what I think is a very important conversation for nonprofit leaders. When it comes to unemployment insurance, many organizations view it as a fixed cost that simply has to be paid. But the reality is that there are often opportunities to better manage those costs, reduce risk, and take a more proactive approach, I guess, to unemployment. To help us better understand those opportunities, I'm joined today by Mike McClay of 501c Services. Mike and his team work with nonprofits across the country to help organizations navigate unemployment claims and identify strategies that can lead to significant savings. So, first off, thanks a lot, Mike, for joining us here today.
No problem. Thank you, Ken. Thank you for having me. Really appreciate it.
So, let's kind of start with the basics, maybe. What are some of the biggest misconceptions that nonprofit leaders have about unemployment insurance?
Yeah, and just to segue a little bit about me for a second. I went down the rabbit hole of unemployment insurance. I used to work in the nonprofit world. I was a social worker, and I worked in various capacities. And from there, I got into this by working with various payroll companies. And I discovered, halfway into my career, I've been doing this for 25 years, that one of the biggest misconceptions is with nonprofits is simply that they're not aware that there's other ways to fund unemployment, right? The misconception is that basically it's two parts. At one, the cost is uncontrollable, and that's not true. There's a lot of different ways you can control whether you're tax paying or reimbursing. We'll get into that. You can control that cost either way. So no matter how you're funding or managing unemployment, you can control the cost. But I think the biggest misconception is that that there's only one way to fund unemployment, and those who are aware that they could become reimbursing, they think of that as, well, that's too risky. That's purely self-funding, and that's not necessarily the case. But every organization is different. You have to evaluate that risk. But yeah, I would say that's the biggest misconception is just the lack of awareness that there's different ways to control and finance unemployment costs.
So let's just make sure we're all clear on what we're talking about here, right? So there's federal unemployment and state unemployment. Nonprofit organizations are automatically exempt from federal unemployment.
That's
So
right.
what we're talking about here is New York State unemployment or multiple state unemployment.
That's correct. So yeah, so if you're automatically exempt as a 501(c)(3) from federal unemployment, right? As far as state unemployment, since 1972, nonprofits have had the option to either fund unemployment by paying the SUI or state unemployment insurance payroll tax, right? So that goes into an insured risk pool with the state that you're in, right? And that's what's used to pay for unemployment benefits when an employee goes to the state, right? So that's funded by organizations' tax contributions. The other way is to be reimbursing, right? Which is to simply reimburse the state based on your actual claims. And so basically you get a bill every quarter versus making a tax contribution.
So what do organizations need to look at? Because when you talk about reimbursing, again, that, as you said earlier, that sounds a little bit like being self-insured for
Mhm.
unemployment. So if an organization is going to kind of move forward with a reimbursing type environment, what do they need to look at? What do they need to consider? How do they approach this process?
Right. And that's a great question because that touches on the first misconception that if I were to use the reimbursing method, I'm purely self-funded, right? And that's one, you can self-fund it, right? But you can also partially insure it. And there's even options to fully insure that risk, right? There's hybrid self-funded programs that are backed by stop loss insurance. So there's actually several different ways you can be a reimbursing employer. And what works best for your organization depends on, your finances, depends on your claims history, right? But I think, organizations need to consider, what their actual claims of unemployment are versus what they're being charged in the state risk pool, right? Because oftentimes organizations are charged a lot more in their tax contribution than their actual claims, right? And when there's a big discrepancy between those two, then it's worthwhile to consider, okay, what are my options if I were to become reimbursing? And you should take a conservative approach when you look at that, right? But I think some organizations, they don't say very much. And one of the first things I'll say is that when you're in the insured risk pool, you're paying claims of unemployment for other organizations. It's a pool, right? So
Mhm.
you're not rated based on you're not strictly rated based on your own performance, right? So one of the first things is to consider is, like, does it make sense to leave the tax pool, right?
So again, maybe you can walk us through your approach in terms of how an organization would determine what's the right approach for them, and what makes sense for them, from a fiscal perspective.
Yeah, so the first thing we do is, like let's say they're a tax-paying organization, right? Which is
Mhm.
typically what we have. That's most of our conversations, right? So it's to look at their actual claims versus their tax cost, right? So for example, I had an organization, and we'll get into this a little bit, that had a tax cost that was about $185,000 a year, right? That was projected based on their IA 97, which that discloses their tax rate at the beginning of the year. But their actual claims, if I did a 5-year average, was less than $10,000 a year. And that's not a typical example, but that's a significant discrepancy, right? And you see that because, their, turnover was pretty low and their claims were fairly low, right? But they're still being taxed, on their payroll. And I think when you see that, it's like, okay, well, we would save if we were to self-fund, yeah, we would save, over $170,000 plus year over year, right? So that particular organization, they actually ended up doing a self-funded program with the stop loss policy. So what that means is that, they don't want to take on the full risk of self-insuring, because what if we have a year where we have $250,000 in claims? Well, that's more than we were paying in taxes. So one part of our process is to look at a worst case scenario. So we'll do projections on, okay, so what would be the worst case scenario in this case, right? And based on what's happened, what's the conservative projection of what your claims look like, right? Because we don't want anyone to become reimbursing if it doesn't really make sense. So for them, they said, well, it makes sense for us to take some of that savings, and we're going to buy stop loss insurance, which basically means that if we did have a really poor year where we did 200,000 more in claims, insurance would kick in at, let's say, that 200,000 mark and begin to pay out those claims. So we're really at that point, we're managing our upside risk in that worst case scenario, but we're still saving over $100,000 a year by being a reimbursing employer. And year over year, that's significant. So I think really we got to look at the claims experience, at least over the last 5 years, versus their tax cost, and have a really good conversation around especially I deal with the CFO and the CHRO, but look at how they can fund that risk. And does that make sense relative to what they could save over the next 5 years? And that's important because you don't want to, I have organizations right now, they're losing funding. It's existential. They're trying to find ways to fund their programs and keep their mission whole. And they want to save money that first year. A lot of organizations don't realize that by going reimbursing, the state still picks up most of the liability because they have a 1 year lag behind those claims. So if you go become reimbursing, almost anyone can save money, right? Because the state picks up most of the claims throughout the first year. But that's not why you want to do this. You really want to look at what is this going to look like over 5 years for me? Is this really going to make sense for me? Is there a way that we can insure and manage that risk over the next 5 years so that we will recover significant dollars that we can put back into our mission? So that's the first way we look at this as an organization. It's like, does this make sense? Is there a way to finance and insure the risk, so that the risk is reasonable?
When you talked about several things and several ways that an organization can structure this, I guess my first question is when you talk about stop loss, when you talk about stop loss, are you typically talking about stop loss on a global plan perspective, or is it stop loss on an individual perspective, or can you create stop losses both ways, similar like you have in health insurance?
Yeah, and that's another really great question because, like I said, if you're reimbursing, I said there's several different ways you can finance that risk, and I came from the insurance industry, right? So, there's several different ways you can finance your insurance program, right? Every nonprofit's insurance program should look fundamentally unique relative to their needs, right? So in this case, unemployment's the same, right? And in which case, we have a program that has a group stop loss that's built into the program where you're setting money aside in reserve to pay for claims. So you're putting aside a budget. So I had an organization, it's like, let's say, hey, I was spending $200,000 a year in taxes. So I'm going to put that aside, but now I'm going to put it in an account that makes interest. And then I'm going to buy some stop loss insurance, right? And you can do that in a group. You can buy a custom stop loss insurance. And even when you do a custom stop loss, you can set, obviously it costs you more money. You can say, listen, I want stop loss to kick in at 300,000 in claims. Great. That'll cost you X. And then, well, I want stop loss to kick in at 200,000. Well, that's a lower ceiling, right? So that'll cost more premium. And one of the things we can model that for an organization. Well, here's what that would cost, and here's what that would look like over a 5-year period based on what we project. We'll even do a worst case scenario if you have a really bad claims year. This is how that would play out, right? We want to make sure the organization goes into this with, eyes wide open, that they really understand all the metrics and the costs to them. But yeah, I think that's the common misconception is that, there's many ways to do this. And oftentimes, that might vary quite a bit depending on the organization that we're speaking to. And typically the large organizations are the ones that will fully self-fund because they can afford to put away capital in reserve.
Mhm.
And the savings is great enough that they hedge their bets that if I have a really poor claims year, that'll happen every 5 years. But I'm still saving significant dollars over the last four. But a smaller to mid-sized nonprofit will often want to purchase some insurance as well as to work with someone that's an administrator. And that's the other part where we come in. And, if you're going to become reimbursing, and really, whether you're taxpaying or reimbursing, administering the claims is going to reduce your costs. So no matter what you decide to do from a financial perspective, managing your claims in terms of contesting claims, and we'll get into that, is essential to keeping that cost low.
Okay, yeah. So there's a whole bunch of questions that pop up based
I
on
opened the can of
brought up.
worms.
So you had mentioned earlier on also that there are ways that um, you can still, in essence, purchase insurance maybe outside of the state unemployment plan, state insurance fund, whatever, that would still provide you with coverage, but at a cheaper price. So, I mean, are there other options under maybe not necessarily being reimbursable or reimbursing, but also have maybe a better option than what the state offers?
Yeah, so think of the state like, going back, think of the state when you're contributing payroll tax, SUI tax, state unemployment insurance tax into the state, that's an insured risk pool, right? So you're in this insured risk pool. And the great thing about that pool is that just to compare is it's unlimited. So you get your tax rate at the beginning of the year, and that is based on claims experience. So your tax rate varies based on how you manage claims. So that's still, if you're tax paying, this is still a cost that you should monitor and control, right? But, because you're an insured risk pool, oftentimes what you're paying from a tax contribution standpoint or your quote unquote premium is pretty expensive, right? So that's where, you're looking at insurance products, in order to fund your unemployment outside of the state tax pool, you have to be reimbursing. So you basically, we should probably talk about what that means. So when you become reimbursing, essentially what you're doing is you're telling the state, I'm going to just reimburse you based on my own claims, right? And the state says that's fine. You can do this. Like in New York, for example, you have until the end of the year to do this. No disruption. The employees have it doesn't make any difference to them, right? So from an employee standpoint, they still go to the state, whether you're taxpaying or reimbursing. The state still adjudicates the claim. So the employer gets a notice if the employer is going to contest the claim because, hey, I terminated this person for cause, right? So I'm contesting the claim because they didn't show up to work, right? Then the state adjudicates the claim. So there's an appeals, a hearing process with that employee. So a lot of that doesn't change. It really on the back end is, if you're reimbursing, essentially you're telling the state, I'm going to decide myself how I'm funding this and simply reimburse you. And then it's trying to figure out, are we going to use insurance to help reimburse the state in that cost? Are we going to fully fund that cost or a combination of the two? Right.
Got it. So you had mentioned earlier, you talked a little bit about size, and you mentioned large organizations and you mentioned smaller to mid-sized organizations. Is there similar to what you have in like health insurance, where you go partially self-insured or self-insured for health insurance purposes? Is there a specific size that it makes sense for an organization to look at going self-insured, or is this really something that's a good fit for any size organization?
Well, because of, I think that's a moving target. And that's a good question because if you asked me that question 5 years ago, I give you a different answer. But if you look at what's happening with the state tax insurance pool right now, the SUI taxes, they tend to go up, and how much of each employee's wage that's taxed tends to go up every year. So we had a 37% jump from 2025 and 2026, so that each employee is taxed instead of on the first $12,800, they're now taxed on the first $17,600, right? So I think, because of that and that rising cost, uh, smaller and smaller nonprofits could potentially benefit. But to your point, you're right. Unless you have, based on the current calculus, at least I would say $2 million in gross annual payroll and at least 50 employees, this probably won't make sense to be reimbursing. You're just not saving enough money relative to the expense and cost to be reimbursing, right? Large organizations, more capital, they have more funding to buy insurance, buy stop loss. They're saving more money outside of the tax pool, so it makes sense to do that. Um, but every case is a little different. The smallest organization that I currently am talking to in New York, they have about 20 employees, right? So they're not very big, and but they're unique in that they're spending, $20,000 a year on employment taxes, and they have zero claims. They've had zero claims every year for 10 years. Right. So we're having a conversation to see if that makes sense, right? And I think, that's kind of an outlier. We don't see that too often. So we'll always take a look, and really that's why we start with, does the math make sense? And we're very careful if you're a small organization, right? But to your point, I've seen small organizations. I had one that was 10 employees that they lost a grant and they had to bear the cost, significant cost for their unemployment claims last year. And in the back of my mind, I'm thinking I would never have coached this organization to become reimbursing at 10 employees. It was just too much risk because of what just happened with that particular employer. So I do see that on the other side of the fence. So we want to be careful. We got to make sure the numbers make sense. But to your point, usually, like, 50 is good, 100's better in terms of employee size, right? But occasionally smaller employers, if they have no turnover and no expectation of volatility or separations or layoffs in the future, those could make sense as well. But that's a really great question.
I do want to remind people, if you have questions, please just throw them in the chat. One of the things then when you're kind of going through that 5-year projection, one of the things you need to, I guess, kind of understand is the stability of the funding sources that an organization has. If they expect there to be any significant declines or changes in funding, that all has to be kind of factored into that thought process as to whether this works or not.
Absolutely. And I think, I do get calls from organizations, because, we're an administrator and we do help organizations figure out how to fund unemployment. And I get calls from organizations anticipating layoffs. They know that they're losing grants or they're in a financial position where they have to lay off X number of people. And so they're looking for a solution. And unfortunately, it's like you can't, if your house is about to burn down or the fire has started, I can't sell you homeowners insurance, right? So if from an underwriting standpoint in the market, if you look at the questions the insurers ask, they're asking a lot of questions in terms of the financial strength of the organization, anticipated layoffs, uses of grant funding. They're asking about specific programs that they know that could be volatile, right? In terms of certain educational programs that typically are hit or miss in terms of layoffs and funding. So, those are all things that you really have to consider. And we've actually, I recently had an organization that called me and they said, we've never had to do layoffs. We're losing a grant. We're laying off 25 people. And I told them, stay put. Let the state bear that cost. Don't become reimbursing. After the fact, I said, what's going to happen? Your tax cost is going to rise as a consequence of that. So I was looking at a 10-year, like their 10-year claims history, and it was very low, like no claims to minimal claims and they had the spike and said, Mike, over the next 10, we don't anticipate this happening again. This is a fluke. I said, well, after, the state pays those claims, then we can look at, you know, potentially moving you into a reimbursement model, which you can do. And then you basically avoid that tax increase, that cost, right, in
Right.
subsequent years, right?
So a question on that. So if I decide to move from a paid model to a reimbursing model, and I have individuals who are already collecting unemployment, do those now get stuck behind with the paid? Or once I go reimbursing, I now have to reimburse for those individuals who have been terminated in the past but are now collecting against us?
That's a good question. It depends on the state that you're in. Since we're sitting in New York, New York is and most states are lag states, meaning that the claim is there's a 1 year lag in terms of the funding. Like the employee is paid, but there's a lag of a year. So that if you became reimbursing for most of that first year, the state's still paying for the claims. They're still liable, right, for those claims that occurred. So because of that lag, if you became reimbursing, you're now suddenly not personally liable, right? And that's why, but that's, you know, to answer your question, when you do become reimbursing, you can't go back for 2 years. So for 2 years, you're out of the state tax pool, which is why you got to look at, does this make sense over really the next 3 to 5 years from a
Right.
financial standpoint? Because the first year you will save money. And I have organizations that they saw that opportunity and perhaps they took it, right? Not realizing that, yeah, the reason why you're saving so much money the first year is because that first year the state's paying for those past claims. They're still picking up that liability. Because the if a person in March, let's say you went reimbursing end of this year, and someone separated from you in March, right? Then for most, they were working for you for 5 years. So they're paying based on a look back for the prior year going back, right? So that's the intent. So if the lag state, again, you'll save the most the first year, but you really have to look at, what that's going to look like in years 2, 3, 4 going forward.
And how long is that look back period?
A year.
A year. Okay, so they cover for a year and then after, okay, got it. So you mentioned a couple times you talked about administrator and you talked a little bit about challenging claims and things like that. So from and I know I see it a lot, but what do you see as the biggest issue or biggest mistake nonprofits are making in terms of managing unemployment claims? I mean, I see so many times where, nonprofits try to be the good guy and it ends up coming back to bite them.
Yeah, and this is, I really think is in terms of controlling costs, this is where the rubber hits the road, right? So because I think the biggest issue is, especially in New York, the perception is it's very difficult, and it is. And organizations oftentimes, I talked to this one organization in New York. They said we just don't bother fighting the claims. It's too cumbersome. It's too difficult. The state takes a very pro-employee approach. Like if you're going to challenge an employee's claim for unemployment benefits, you really have to, the burden's on you as the employer to present evidence and significant evidence to the fact that, hey, no, they didn't show up to work and we clearly lined up expectations and they didn't do this. And if you don't have a little document, it's very difficult to win that case. So to your point, like right now in the state of New York, the average win rate on claims is less than 40% in New York, right? Our win rate with our New York clients is just over 90% on protestable claims. So that's a 50% difference. So in terms of cost control, imagine if you're reimbursing or even tax paying, and you can reduce the claims by 50%. I used to work in other areas of the insurance world. I can't think of one thing you can do with any other insurance line that would reduce that cost by 50%. So really managing the claim is critical. And I think the first thing is just responding. I think the biggest issue is responding in a timely fashion because you have 10 days from mailing typically of when they send you the notice to then receive the notice and then respond. And if you fail to respond timely to the notice, then they grant the claim, right? So you have to respond and have to be ready immediately with your evidence, and you have to be tailored with your response.
I think a lot of organizations don't quite understand that whether they are paying into the unemployment system or they're reimbursing, that there is a direct correlation between claims that are being paid and the amount of money that they have to pay for the premiums on on the insurance. And I
Yeah.
think what ends up happening is, like I said before, nonprofit organizations, a lot of them tend not to want to push back. They feel bad that they're letting someone go, even though the person maybe deserves it. And then you wind up in a situation where your unemployment rates go up, like I said, even if you're not reimbursing, because you didn't do anything proactive to stop it.
Yeah, and I think, that's part of the, I think because this is by, if you start a nonprofit, the default method of paying unemployment is in the tax pool. You pay it through payroll tax and that contribution. So because it's linked to payroll and a payroll tax, the perception is that this is a fixed cost,
Yeah.
like Social Security and, your FICA, Social Security, Medicare. But it's not a fixed cost. So the lowest rate you can have in New York, for example, is 2%, right? The highest is 9.9. And that's based on your claims experience. So the more claims you have, the larger your tax rate is. So even if you're going to stay tax paying, like, so I'm talking to a small organization, I said, but whether or not they become reimbursing, I'll talk them out of reimbursing if they're like 10 employees. But I said, you know what? You should be controlling that cost. You should be at least responding, and be thoughtful in how you're responding to those claims and educate yourself and, attend webinars and trainings. There's a best practice for how to manage and respond to unemployment claims, right? So that, there's a consequence in terms of the tied to cost, depending on how you manage it.
So you kind of touched on it a little bit, but I just want to know if there's any other steps that organizations can take to reduce their unemployment liability and control costs. I mean, you already talked about challenging claims and looking at that stuff, but what else can organizations do?
Well, a lot of issues in terms of managing separations. I guess I should back up for everyone listening. And, essentially, and I'm going to oversimplify it, but it's, you know, a separation that's no fault of the employee. Like you lay someone off and it's no fault of their own. That's someone that is eligible and that they'll get unemployment, right? So it's a non-contestable claim.
Hmm.
You could try, you're not on those grounds, you're not going to be able to contest, right? So the contestable unemployment claims are someone that's terminated for cause or abandons, like they don't show up, right? Those are contestable. So in order to contest those in every state, again, the assumption is that the employee is right, it's employee friendly, right? And you have to present a burden of proof. So if you terminated someone, I'll give you an example that just happened recently with one of our clients because they're consistently late, right? You have to demonstrate, well, were you clear on the expectation of when they arrive to work? What is your documentation of that? Is that in their job description? Did they sign off on a timesheet? When you had this conversation, it didn't just come out of left field. I mean, we want to see progressive discipline where we had three conversations that the employee signed off on that, hey, you were late to work and you're work in a program watching children with developmental disabilities. It's really important that you show up on time, right? Because we need to relieve the prior staff, we need to have appropriate staffing. You need to show significant progressive discipline in order to be able to, when you get to that claims hearing, right, and the state adjudicates that claim, to be able to present that to contest that claim, right? Without documentation, right? Or even like another example, like the issue is lateness, and then the employee does something else that the company doesn't like, and they terminate him based on that other issue. Well, then you don't have any progressive discipline. And the last event before the termination is how the claim is judged, right? So that's where well, we do a lot from an HR standpoint to help HR personnel develop best practices. And part of that is developing policies, laying out expectations clearly, right? Making sure that, when you do have a disciplinary issue that you're documenting that. It's really, a lot comes down to document, document, document.
Yeah.
I'm sure we hear that a lot in the nonprofit world, and it's no different with regards to unemployment. And it can be tough. I mean, also you know, I think we have a 90% success ratio because this is what we do as a profession in terms of, going to claims hearings. But we had a claim that, we had an individual that was falling asleep in a residential program. So he's responsible for watching others, and he's falling asleep on the night shift. And that was why he was terminated. But we almost lost the claim because the judge said, well, I have a video of him falling asleep, but it was a still image of him like this. And they said, well, that just shows that his eyes are closed. That doesn't demonstrate he's asleep. So yeah, so we had to pull video and make sure to edit video because we couldn't have any other image people in the background for HIPAA reasons to demonstrate that no, clearly this individual was sleeping, right? So that was the difference between winning and losing that particular claim.
So it's a high standard, as you're saying.
There's a yeah, it's a fairly high standard, to deny someone their claim of unemployment. And I think the spirit of that is that, the intention is that the state is giving benefits to help someone, while they're looking for a new job. That's roughly 50 to 60% of their pay, right? But again, I think, you know, you don't want to be funding unemployment for people who are not eligible and don't deserve to have that benefit. And there's clear criteria in terms of who is and who is not eligible based on the nature of the separation.
So how does that work in a situation where someone works for me, they leave me, they go to work for someone else, they last there for a month, and then they get terminated there? What recourse do I have? Because after 4 weeks of collecting under the other person, they're going to be coming back and collecting under me. What recourse do I have there?
I love that question, Ken. I love that question because that's a great example. So someone leaves, they quit, to be clear, right?
Yep.
This is someone who left of their own accord. All right, they quit of their own accord. They're not eligible for unemployment. But assuming you didn't contest the claim, right? Assuming that, like, so you suggested they didn't make a claim until the second employer?
So they left, they went to work for somebody else, they lasted a month there, and then they got fired.
Got you. Okay. So what could happen is, you know, you have what's called base period claims in New York and a lot of other states where, you actually will be assessed a contribution to that unemployment claim, whether it's a contribution that's going to increase your tax costs or a monetary cost that you're going to have to reimburse the state. And so you're in a position where you have to contest that claim as the first employer. And that goes all the way up to the third employer. So let's say they're let go, or if they're fired and they claim unemployment, what's going to happen is basically both employers are going to have to contest the charge, right? So obviously, if he's fired for cause and the first and the second employer is successful, then you're not going to have to bear the burden of that cost, right? But if that second employer is not successful, right, then you have to contest that claim and say like, hey, I have documentation. He quit of his own accord, so I shouldn't be responsible for that portion of the claim. That should be strictly the second employer's responsibility. But I think that's another issue that a lot of nonprofits are not aware of is that you're responsible for a portion of the claim if they when they go to the second or the third employer, right? And that's based on payroll and based on a look back of how long they were working for you, right?
Right.
So that situation is frustrating when you have an employer, and this is the same if you're reimbursing or tax paying, but it could be frustrating because what happens is you have an individual that maybe worked for you for 3 years, they go to another employer for a month, right? And then they separate and they claim unemployment, and you end up bearing the lion's share of the cost because they work for you for a long period of time, right? And that's where really understanding the claims management process and where, regardless of the nature of the termination, that you're documenting those separations and you're laying expectations out very clearly. And you have a communication with that employee. Okay, this is why we're separating. Preferably, if you can, you get something signed or an exit interview. This is part of the benefit of an exit interview is you have the opportunity to get documentation and have clearly establish, okay, you're leaving for cause. Let's have a conversation about what happened. What could have happened differently? What are your expectations? And get someone to sign off that they're leaving of their own accord, right? And then you have the basis to contest that claim if if it happens in the future.
Yeah, guys, that's interesting because a lot of times when you think about it, you're not really getting someone to sign off on the fact that they're leaving on their own accord.
Right.
Um,
Sometimes they quit and you can't. There's a practicality to this where, sometimes you're not going to get that opportunity. But, I've been in other positions where, I'll have another offer to come work for a company and I say, hey, I'm giving my notice. And there's an interview process, like an exit interview, right? And I think the big part of that process is to make sure that the HR is documenting why you're leaving. They're getting great feedback, right? Well, I'll get into this in a second, but HR really was developed, and the reason we have HR is supposed to be to develop great culture and attract the right people, great people to your organization, right? And the exit interview is an important part of that, understanding why people leave, right? And what can we do to reduce separations in the future, right? And of course, then to protect our agency and make sure that we're clearly documenting, why we're separating that relationship.
Okay, so there's a lot of people who work within an organization, right? You have your HR folks, you have your fiscal folks, you have your executive
Mhm.
leadership, and everything else. When we're talking about managing unemployment costs, is that kind of relegated to your HR folks, or do all of these individuals play a role in kind of that management process?
That's a great question. I think it is typically relegated to the HR folks, right? Most of the time. Um, on the financial considerations, when I'm talking to finance committees, I'm talking to the CFO. But I really think, leadership tends to overlook costs associated with separations with unemployment. But, I came from the insurance industry and looking at risk as a whole. And if you think about, like, we look at when you have a separation, if you have an employment practices liability claim, over 70% of the time, it's because of how something was handled or a perception of how something was handled at the point of separation, right? So how you handle separations tend to have a rippling effect in terms of your overall cost and liability, not just with the unemployment itself, right? And I also find that, I'm a data geek, and I look at if I have a social service organization in the Bronx and I compared them to all their social. So let's say they're dealing with individuals with autism spectrum disorders, children, right? And I compare like organizations, and I find, hey, this one has a much higher turnover than this one. And I noticed that if you have higher turnover, typically you have more claims, not just with unemployment, but more claims and more insurance cost, right? So, really like looking at separations tends to be an overlooked barometer of health for your organization as a whole. So that's where I think, leadership should get involved in terms of looking at the big picture and really talking to their HR department in terms of how they're managing the separation and really making sure they're getting the feedback and why do we have separations? Is it benefits? Is it culture? Right? Is it maybe we hired someone and we put them in a social service and we put them in a direct care role and maybe that wasn't the best fit. Maybe we should have had them do that, right? And that's an important part not only of having a great culture and people really align with your mission, but also that'll reduce cost overall. Because I've seen it just in the data, looking at risk and insurance and cost. Another thing is, I want to get into real quick, and this is something that fascinates me that most nonprofit leaders don't recognize. If you look at turnover and you look at costs associated with turnover, right? Like take your average social service nonprofit that's providing direct care and has people in the street providing services to the community. They tend to have a much higher turnover. I'm not talking separations, but people like come in temporarily, they leave. People don't like, I was in a direct care role in my past life working with adults with autism. It's very difficult work. People don't stay. That's very difficult to stay and do that work. So you have a lot of turnover with direct care providers. Every time you turn over, that first $17,600, you're paying unemployment tax on that first 17,600. But if that position turns, you're resetting the clock on that. So what I've seen is that, and a lot of nonprofit leaders and financial people don't realize is that if you have an organization with organically, no fault of your own, with this higher turnover, you're going to be paying a lot more in unemployment taxes than your for-profit peer that's like a law firm that maybe has low turnover, right? And so they might have a lower tax rate. They might be maybe under 4%, but they don't realize their cost of unemployment is significant because they're paying unemployment taxes throughout the year because they don't cap out because they turn over those certain positions frequently. Does that make
Yeah, I
sense?
think one of the yeah, I was going to say I think one of the problems that you have is, especially when you're dealing with direct service providers, there's such a shortage of them, and these are low-paying jobs that it really is, it tends to be in many organizations a transient sort of job because you just can't keep these individuals no matter what you do.
Right.
And you're kind of forced to hire people because you need bodies in order to be able to provide and deliver the service that you're required to provide. So it's kind of a tough situation that organizations find themselves in. And it's not always easy to just say, hey, I'm gonna just hire the right person because half the time you can't find the right person.
Yeah, and I think that I hear it a lot from the nonprofit industry in terms, especially with direct care workers, is that a lot of them they will claim unemployment, and it's you know like we're in a position. I've had client calls me like, I don't know if I don't want to contest this one, and that's fine as long as you understand that that's tied to a cost, right? And you go into those decisions with eyes wide open. But many times if you look at if they leave of their own accord or, and this, like they're falling asleep in this case, you terminate them for cause, then you should contest those, because
Right.
that's going to cause pressure on the organization in terms of financial pressure that's going to increase their costs over time. And another thing I wanted to mention is that, the state unemployment tax pool last year was in debt to the federal government. So they're running insolvent. So in order to keep running the fund, they were borrowing heavily from the federal government. So they were in debt by $7 billion. Right. So last year they paid off the entirety of their insolvency debt. And in doing so, they also increased to keep pace with inflation, the maximum benefit increase from $504 a week up to 869, which is about 72% increase. Right? So that's something that we should consider in the calculus. And that, by the way, you're not going to be able to collect 869 unless you're making over $100,000 a year. But across the board, that max benefit will increase based on how much that person was earning. But the takeaway from this is that, you know, because they were running insolvent, they don't want to run insolvent again. So what they're going to do, they already increased the wage base and they're going to continue to increase that wage base by 18%. And that's basically not a one-time change. It's been indexed to increase that wage base 18% every year going forward, right? So the one biggest takeaway is that, if you've looked at this in the past and decided that, we should stay put, whether you're reimbursing or tax paying, because of these changes, it makes sense to look at the calculus again
Right.
to see if, the decisions you might have made around how you fund your unemployment maybe 5 years ago, really, if it still makes sense to stay where you are currently.
So what should boards, finance committees, and management understand about unemployment costs that you kind of see is often overlooked?
I think the biggest takeaway is that it's controllable, and that, again, that perception, like for example, I was talking to a nonprofit that was one of our clients, and they weren't like we have this outplacement service, whereas an outplacement service basically gives job hunting and job seeking and job coaching to separated employees. Which why would we do that? That's going to cost the organization money. Yeah, it'll cost you money, but also it can reduce the size of the claim by 20 to 40%. Because if you can help that employee find their next job sooner, they're not collecting benefits as long. And that's a big return on investment. If you can then cut, like if you're have an organization spending, they have $1 million in claims and they can cut that down 40%, that's $400,000.
Right.
Right. So there's all these different ways that I think a lot of nonprofits don't realize that you can do to control costs. And I think really when it comes to manage, just like you manage workers' comp risk and you manage your liability and your property risk, managing unemployment is like managing another risk. You have to have policies and procedures in place to manage that risk, and you will see significant returns with risk management around separations. I find that risk management around separations have a high return on investment. Whereas, well, hey, listen, we implemented risk management. Everyone now wears gloves and we're getting injured 20% less, right? Which would be a fantastic return for workers' comp. But I've seen even more significant returns by just tweaking procedure and having more training about how to deal with separations.
Cool. We're kind of running low on time, so just one last question. What trends are you seeing right now that nonprofit leadership should be paying attention to?
Well, I think just like I said, it goes back to just the rising costs within the tax pool right now, also the rising cost of benefits to keep pace with inflation. But one big topic that came up, I was at a conference and we were talking about AI. And if you think about what AI is going to do in terms of increasing and putting pressure on the unemployment tax pools and really being aware that you have options and really paying attention to what's happening in those pools, because if those pools continue to increase benefits, increase wage-based taxes, then as a nonprofit, I think that's driven by for-profits laying people off. Whereas in the nonprofit world, AI is going to change how the organization is run. It's not going to, we still need people to deliver on that mission, right? So why should you as a nonprofit have to bear the burden of that cost? and that pressure on the unemployment tax pool. So I think really it's just the biggest takeaway is to really have an awareness that a lot's changing quickly. And if you haven't looked at what you're doing with your unemployment, how you're financing that and managing it, now's the perfect time to examine that cost and how you're managing it.
Great. I appreciate it. So, Mike, thank you for sharing your insights and expertise with us today. For everyone who joined us, we hope the conversation gave you a better understanding of how unemployment costs work and the opportunities nonprofits have to take a more strategic approach to their unemployment. If you'd like to learn more about 501c services or discuss your organization's specific situation, what we'll do is when we send around the recording of today, we'll also send around information on how to reach out to Mike and have a conversation with Mike so that you can kind of benefit from today's session. Thank you, everyone, for joining us for another Cerini Connection. We appreciate your time. We're looking forward to seeing you again in the future. If you felt this was good, please pass it on to other people and let other people know. The more the merrier. So have a great afternoon, everyone. Thank you for being part of this.